I don't think Bitcoin's story is broken. I think it is waiting for clarity, but institutional adoption's growing. So I still don't think $200,000 Bitcoin is that crazy. It is just a doubling in price. And think about where gold was and how silver's moved. Historically, those big parabolic moves in crypto follow parabolic moves in precious metal.
Tom Lee opens with a striking observation. Right now, gold looks far better than Bitcoin, the asset often branded as digital gold. And this isn't just about price action, it's about behavior. Traditionally, Bitcoin was expected to perform in one of two ways: risk-on, outperform during rallies; risk-off, act as a hedge like gold. But according to Lee, Bitcoin hasn't consistently done either. When markets go risk-on, Bitcoin hasn't surged the way many expected. And when markets go risk-off, it hasn't provided meaningful protection. The reason, he argues, is deleveraging. Before we go on, just a quick reminder: liking the video, subscribing to the channel, and commenting helps this reach more people who care about Bitcoin and macro trends. Appreciate the support.
Tom, gold, I'll tell you what, looks a heck of a lot better right now than the alleged digital gold, Bitcoin. What's going on there? Risk on, it doesn't really do anything now. Risk off, it doesn't do anything either. What's it correlated to, if anything?
I think crypto has been suffering from deleveraging. You know, in October 10th, there was that one-time price shock that was the biggest deleveraging of crypto in history. And then this week, crypto was doing well until the Greenland announcement, which triggered the move in JGB yields and a deleveraging in crypto. So I think crypto, unfortunately, is sort of would track gold, but you have to subtract deleveraging, and I think that's really what's been hurting crypto.
I mean, people, these calls it, oh, it's the the new reserve currency, break out the gong on that. That it's the new gold, break out the gong on that. I mean, have you rethought where you thought that this could go over a period of time? Because your targets on it were so unbelievably lofty. And now I question as to whether they could ever be reached.
Yeah, well, I think Davos was pretty eye-opening. Larry Fink talked about everything being tokenized onto a common blockchain. David Sachs talks about how once the Clarity Act's passed, digital assets and basically the architecture of Wall Street are going to merge. I think crypto is still really relevant as a settlement layer, but it is more a story of smart blockchains, which is more of an Ethereum story over Bitcoin. And as you know, Bitcoin maybe is getting dinged because there's some concerns about quantum being able to steal or capture a third of the Bitcoin legacy wallets. I don't think Bitcoin's story is broken. I think it is waiting for clarity, but institutional adoption's growing. So I still don't think $200,000 Bitcoin is that crazy. It is just a doubling in price. And think about where gold was and how silver's moved. Historically, those big parabolic moves in crypto follow parabolic moves in precious metals. So I don't think that this is a broken story unless it doesn't happen in the next couple of years.
It's been a turbulent week.
It has.
Is it portend something that's going to come forward here for us?
Well, part of it is, of course, as you know, we're in earnings season and markets tend to be volatile around earnings. I'd say that some of the high-profile declines, like Intel, look bad over a one-day period, but Intel was $17 a year ago. So to me, it doesn't surprise me that you could see some of those stocks have done really well get punished a little bit on earnings.
I mean, this is a hard one to say it's representative of anything. I mean, the company's obviously been challenged. They have the government backstop in there, and the stock was up a ton going into the print. As we turn, speaking of the prints that matter next week, the mega caps, which you still love, but not quite as much?
I mean, we still like the Mag 7 and the mega caps because they're great earnings stories and they have a lot of visibility. But as you know, our top picks this year in terms of sector is energy and basic materials. But as far as earnings stories go, I think next week's critical because you got most of the Mag 7 reporting.
Tom, you're crushing that so far with that call. Energy and materials are the two top sectors. Yeah. Why were you leaning that direction as the year began?
We were betting a bit of mean reversion taking place in 2026. One of the things we identified in our 2026 outlook in early December was that energy and materials underperformed over the last 5 years at a level that in the last 50 years have marked turning points higher. So we were betting that so much of the bad news was baked in that they could have okay fundamental years, but the stocks could do really well.
Lee explains that energy and materials have severely underperformed over the past 5 years, to a degree that, historically, has marked major turning points. In fact, the level of underperformance reached in these sectors has only occurred a handful of times in the past 50 years, and each instance was followed by strong relative performance. The thesis isn't that fundamentals suddenly become perfect. It's that expectations are already so low that even okay fundamentals could drive significant stock appreciation.
I feel like you were on the right path as it pertains to small caps and the Russell just a little early. Maybe.
Yeah.
I mean, remember, let's remind people, last year you told me up here that we were going to have a 50% gain in the Russell.
Yeah.
Now, obviously, we didn't have that, but the Russell is almost outperforming everything else over the past year, and in 1 month it's up 5%.
Yeah.
Is that going to continue?
Yeah. One of the things we talked about a lot about last year was that when small caps turn, it tends to be a multi-year. In fact, it could be up to a 12-year period. So the last turning point for small caps, and on a relative price to sales last year or price to book, they were at the exact same point they were in 2001. That was a launch point for 12 years of relative outperformance. So I think small caps benefit from a Fed turning dovish, possible M&A wave coming, an ISM turning back above 50, and then catching up to where EM, because EM did really well last year, and small caps usually track that. It didn't.
Fed turning dovish, we have a meeting next week, in case you didn't know, and not expected to do anything. So maybe not as dovish as people thought several months ago. And by the way, as we look at prediction markets, as we think about who might be the next Fed chair, BlackRock's Rick Rieder is now the leading contender in prediction markets. There's Kalshi. We, of course, have a partnership with them. 52% leaning towards Rick Rieder. We shall see. Do you care how much you think about who the next might be?
It's important because it reflects the market. Market needs to respect who the new Fed chair is. Rick Rieder is somebody that markets really do respect. So, as you know, the Fed has to communicate not only with the White House, but also with the bond market. And I think Rick Rieder's experience in the markets world makes him very credible.
But you're not expecting anything next week, right?
I'm not, but I'm also expecting the Fed to reiterate that they are focused on no longer fighting inflation, but looking at the job market. That's a Fed put on the economy. To me, that's a dovish tilt. And as long as they're not fighting inflation, to me, that's a dovish Fed.
And that's why you think the equal weight S&P is up 4% so far this year compared to the S&P, which is up 1%, and the NASDAQ, which is only up 1.5%?
Yeah, I think so, because as you know, not only is the Fed no longer is trying to establish inflation credibility, which is hawkish, QT has ended, which to me is the same as a version of QE starting. So we are facing a dovish Fed. Even if there aren't cuts, it's still a Fed that wants the economy to do well.
I'm not sure everybody sees every appearance that you have, and people generally think you skew bullish, which you obviously do. That said, you're still looking for what you've said could be a bear market in the middle of the year. Do you want to explain one more time why, even in the midst of this bullishness we hear from you, you still think stocks could have a bit of a rocky road at some point?
Yeah, I think 2026 has the same contours as last year. So in 2026, I think there's a good fundamental earnings story, earnings growth accelerating. But we have two transitions to deal with. One is the Fed, a new Fed. The market always tests a new Fed. So from confirmation, let's say that starts in March, a new Fed happens, and then the market tests him. That's one source of a drawdown. The second is, of course, policy. The White House is much more deliberate this year in picking winners and losers, and there's some uncertainty around the tariffs. Last year, that was enough to drive a 20% decline in the S&P. So I think the combination of policy uncertainty along with Fed could create a drawdown that feels like a bear market, but that's from higher levels as well.
Did it make you nervous, the events of earlier this week, speaking of policy uncertainty? You just don't really know what's coming anywhere for that matter, whether it's social media or policy by post or what have you. What did you learn, if anything, about Tuesday's events and then how the market acted subsequently?
Well, I think it's a prelude to what a bigger drawdown looks like, because just a social media post about Denmark caused a 2% decline in the S&P and a spike in the VIX. And that was, of course, quickly diffused. But imagine a scenario where there's a series of policy headlines that markets get anxious about. It could easily lead to a larger drawdown.
Which some expect more volatility. Tom, I mean, we're going to be reminded of something next week. Either reminded why we lean so heavily into these names, or reminded why we've started to move in other directions in the market.
Yeah. I mean, and it could be a mixed bag, that I think you might have some tech names do really well because they're surprising and they're reiterating guidance, and maybe there's a couple stumbles here and there. But to me, it's still, as a group, linked to the AI trade, and I think it's still a central driver of not only U.S. but global GDP.
Let's find out what others think as well. Let's bring in CNBC contributor Malcolm Etheridge of Capital Area Planning. Guys, good to have you. What about that, Malcolm? More volatility ahead after this turbulent week?
Yeah, I think we're certainly in for some volatility, not only through the entire year, but possibly this quarter. I don't think that Greenland is necessarily a settled case. I don't think that all of the president's agenda that he's going to want to get enacted before the midterms happen. I don't think we've heard the last of it. And Tom makes a great point about years where a new Fed chair comes in and what the market's reaction is to that immediately following. So I think that there's definitely a ton of volatility coming. But more specifically, next week, I think, sets the stage for some of that volatility. If any of the four Mag 7 companies that we're scheduled to hear from, Microsoft, Apple, Tesla, and I'm blanking on the fourth one, sorry, but that's 15% of the S&P 500's Apple. Thank you. I don't know how I could forget them. But that's 15% of the S&P 500's weighting. And that is very important because it's going to determine whether the rotation away from tech continues, or if we hear guidance from those four companies that backs up what we heard from TSMC a little bit ago, that basically bookings are sold out through the entire year, and the money that these companies have been spending is not going to slow down anytime soon. That is very helpful for materials, construction, utilities, those kinds of names. And so I think it helps to keep the party going within tech. Or if we do hear some weakness in that guidance, maybe it starts to show that more of a rotation into IWM, the small caps, things like that Tom's getting excited about.
Malcolm, gold, it's just about at 5,000. Silver's at 100. I mean, these are record levels for both. How do you feel about, clients getting exposure there if they don't already have? Are you a believer that the trend just continues to move higher?
I do. I think that we go from 5,000 and then we start talking about when do we see 6,000, because the angst in the markets that we're talking about, it's not going away. And it's also not going into the 10-year Treasury the way we historically would expect it to do, with yields continuing to rise. And so I think that gold more than likely continues to be the safety trade globally for investors who are either selling away from America, or U.S. investors who are also thinking maybe I ought to be looking somewhere outside of the S&P 500.
Finally, Lee reiterates that AI remains the central engine of growth, not just for U.S. equities, but for global GDP. While earnings from mega-cap tech may be mixed next week, he expects the AI narrative to remain intact. Some companies will surprise to the upside, others may stumble. But as a group, tech remains structurally important.